Okay, let's answer some questions from Sunday's Q&A. I've read quite a few of the questions. Some of them I'll just be seeing for the first time. In your NASDAQ 100 section, you listed several explanations for the run in triple Q this year, which all make sense. I think where I'm struggling is the comparison of value versus growth stocks in general in different parts of the business cycle. I understand not all growth stocks are tech stocks, and that many and most tech stocks are growth, but not all. In an environment like ours, with capital market rates high and most likely remaining high, shouldn't growth stocks valuation see more resistance versus value, all else equal? Yes, I will absolutely agree with that statement. So that rally that we've had in the first quarter does strike you as odd almost right away, because this does not seem like the environment where growth should be rallying, especially growth tech. Only because if we take the Fed at its word, rates higher for longer. Cost of capital will be higher. And if the economy is resilient, which is what the first quarter rally seemed to be about, then there is no cutting of rates. And if the economy is resilient at higher rates, well, there's your new neutral rate, 5%, not 2.5%. So I agree with that statement. Seems to be the opposite recently. Year-to-date growth stocks are up 6%, values down 6%. Guess what I'm asking is, have many of the NASDAQ 100 components moved beyond being pure growth stocks? Yeah, I've been hearing this argument that Facebook is a value stock, Netflix is a value stock. I've been hearing these arguments. They don't have the PE multiples to suggest that they are a value stock. Of your 5 bullets for the NASDAQ 100 run, how would you rank them? I think that a lot of the performance was due to cost cutting, because a company would announce that it's cutting $4 billion in costs, and the next day it would just pop, and then it would be followed by upgrades from analysts, and then it would show a little bit of momentum after that. So a large part of the price increase was due to the fact that tech companies that are heavy with labor can engineer their bottom line. Even if revenues don't show up, they can engineer their bottom line by cutting costs. Feels like momentum and AI optimism are the overwhelming drivers here. Yeah, AI optimism has something to do with it. It's a little bit of bubble forming inside tech. And that, of course, momentum is created by itself. You witness prices going up, and more people are drawn to prices going up. Then more people start talking about prices going up. Then more people are drawn to it, and then it goes up even more, and more people start talking about it. And it's like everyone's saying, I got to get on board. Which also causes short covering as well. Let's see. Does purchasing zero duration holdings such as equity from capital injection? Zero duration holdings such as equity from capital injection. I don't know what that means. Into a portfolio of bonds and equity, reduce a portfolio duration. Well, when you say equity, equity is a big class. I mean, you've got all sorts of different companies in equities. Bank stocks are equity, but they have duration. They are interest rate sensitive. Some companies are not interest rate sensitive. So equities do have some interest rate sensitivity. So it's not as if they have no duration. Some equities, like mortgage REITs, have very high duration because they're very sensitive to changes in rates. So if chosen correctly, like anything, if you can find something that has a low correlation with the rest of your portfolio, doesn't matter what sensitivities it has, as long as you're finding something that has zero correlation, it'll have maximum diversification. I'm consistently running into a problem, progressively entering into a position rather early. Well, welcome to the club. So do I. I am always early to a trade because I think 4 or 5 moves ahead, and most of the time the market thinks 1, maybe 2 moves ahead, so I'm way ahead of the market. I am typically early. Last week ES went bonkers up, and I'd already maxed my position before Friday, selling ES all the way up. Everything, in my opinion, suggests that this is desperate hope without any fundamentals to back it up. I agree. We're seeing that this week. Yesterday we saw no reason to rally. We sold off, but in the last 30 minutes we decided, nope. wrong move. Let's go back up. Today we sold off again. Last 30 minutes we said nope, 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 wrong move. Let's go back up, and it's just going to take, think about it as a scale, right? If you think about it this way, you have your bullish case over here, and you have your bearish case over here. Well, ISM manufacturing went here. ISM non-manufacturing went here. ADP, which is always wrong, also went here as well. So you had, you have a little bit more each and every time, little grain of salt, little grain of salt. Well, those little grains of salt eventually get to the point where, I got to give it to American bulls. They do have the astounding ability to ignore almost everything. That every time some bad news shows up, like they could be sitting on their chair at home. There, let's get them sitting in their chair, looking out at the mountain range over here. Let's get the mountain range over here. And there could be just a glimmer of hope over here, and they will buy. Meanwhile, there could be a rattlesnake over here, and they'll just keep sitting here saying, oh, somebody will take care of the rattlesnake. Somebody will take care of it. But they will be all excited about this glimmer of hope. That's the American market. You give them a glimmer of hope, and up they go. You put a rattlesnake in front of them, well, somebody will take care of it. Right? The banking crisis is over. I mean, it's backstopped, right? They're going to solve the debt ceiling, right? I mean, the credit, the real estate, commercial real estate, that's going to be contained to that market, right? But look at the glimmer of hope. The Fed is going to pivot. Even though the Fed has said we're not going to pivot, we're going to pivot, they're going to pivot, we're going to price in 4 rate cuts. So 4 rate cuts are already priced in. They're looking at this glimmer of hope. There's the rattlesnake. Well, eventually that rattlesnake gets close enough where you can no longer ignore it. That's why markets go up like this, but down like this, because you actually have to be bitten by the rattlesnake before you get off your goddamn chair, right? Let's see. Desperate hope without any fundamentals. I agree. I didn't do anything while the market went up. I suffered. I watched my position. I said, But, I was perfectly comfortable sitting with it. My position is pretty underwater despite my safety measures and best guesses. So is mine. I was able to anticipate some momentum and avoid more significant unrealized losses, but I'm getting pissy. When the market is making you angry, it's usually the end of something. And that's the way I feel. Like when the market keeps going up to the point where I just can't believe it anymore, and I think, come on. Like, well, what do you think is going to happen here? That's when I know it's pretty much over, when I get to that point. I'm honestly wondering what I'm doing wrong here. Am I just acting too short term? Probably looking too short term. You have to, when, the market doesn't know you're short. The market doesn't know anything. From day to day, it'll do what it wants to do. You have to just ask yourself, is your story still in play? Is the Fed still committed to raising rates? And all the Fed speakers say they are. Loretta Mester was on Bloomberg this morning, and she says somewhere above 5. She's not just one more rate increase. She's at least 2 or 3 more rate increases. She doesn't think that we're getting back to 2% till 2025. If we listen to the Fed, all the Fed speakers, and take them at their word, no one's cutting this year. No one's cutting unless they have to. So the market pricing in 4 cuts, the only condition under which that happens is something really bad happens to make the Fed say, let's take our eye off inflation because this is the bigger problem. Even though they've already said there will be some pain, they're willing to go through the pain. So 4 rate cuts being priced in must be something very bad happening. But the market just doesn't seem to want to get it through its thick skull that it is probably more room on the downside significantly than on the upside. It just takes time. Let's see what I'm doing wrong here. I get the impression that I'm reacting too quickly. Specifically, what's your process for observing, reading, reacting during the week? Are you omnipresent in front of your IBKR station? No, I am not. That is the worst thing to do, is to sit in front of the screen and watch it all day long. It's the worst thing to do because it's just going to make you, your emotions will turn into a roller coaster. you got to walk away from that shit. You just got to walk away from it. And then you just have to ask from day to day, when the economic data is coming out, is my story still in play? Has anything happened that would nullify my belief? Now, OPEC cutting production and the price of oil going up, that doesn't make the bull case stronger. If there is a bull case, that certainly didn't make the bull case stronger. It probably makes it somewhat weaker because, well, more money is going to be spent on gasoline than would be spent on crap at the mall. So, when I look at the data that comes out, I think, well, none of that makes the bull case. And none of that breaks my bear case. In fact, if I had to put something on the scale, I'd probably be putting a point here, 8 points here. There's a point here. 8 more points here. There's a point here. I mean, the weight on this side is overwhelming. But walk away. Don't stare at the computer screen all day long. Just ask yourself, is my thesis still in play? And always be thinking, what would make me change my mind? Here's the thing that would make me change my mind. The Fed says at the next meeting, we're cutting rates. That's it. My short position is done. The moment they say they're going to start cutting rates, I'm done on the short side. I am done on the short side. It's over. Unless something really big broke and they're cutting rates to try to save the economy, but it's too late. The genie's out of the bottle. Then I'll keep my short position for a while. But at this point, given where we are, if at the next meeting the Fed says we're cutting rates, that's it. I'm done. I'm out. Good point on ChatGPT, but I think you also answered your own question on why we need computer skills in CFA. One still needs to understand the code to control if it makes sense. Yeah, that's true. It makes you a good consumer of code, I imagine. The same way that we learn correlation formula or linear regression, even if in practice everyone uses tools to run it. Yeah, I can take that. The thesis that corporate profits might revert from 12% back to 6%. Well, it's not that it's a thesis that it would return to 6%. 6% was always, for a long time, a mean reverting level. And then it just simply jumped up. And I had given some possibilities of why it would be more. Well, because you have some companies now that have not increasing returns to scale, but decreasing returns, continuously diminishing costs or diminishing marginal costs as opposed to increasing marginal costs, which is like a diseconomy of scale. Well, you don't have that with technology. So, and being that we have outsourcing to China where things are far less cheap to have made, but lower pricing was really, or the lower costs were captured by higher margins. Maybe we had a new higher mean reverting level. I don't know. But, if we revert back to the historical mean reverting level, that would be 6%. So it seems important to understand it deeply. Do you know of any papers, academic project, other sources that have studied this dynamic? Yeah. Go to Google Scholar. And type in corporate profits as a percent of GDP. All you need are some keywords and you'll find a bunch of papers, and you really only need one good one. When you get that paper, if it's a good paper, you simply have to go to the footnotes, the bibliography, and from that bibliography you will find links to all the other supporting papers that it cited. Cost, supply of housing, driving wage inflation. These are more data on this. What percentage of average wage is spent on rent today versus in the past? I really don't know. Has this driven inflation in previous cycles? Again, I really don't know. It's me hypothesizing based on observations, based on just looking at where rents happen to be, looking in Ontario where minimum wage happens to be, and then putting the two together and saying, how is it possible? How is it possible, even if you're making $50,000 a year and you have a one-bedroom apartment, how is it, on an after-tax basis as a percent of disposable income, how is it possible to pay for that and ever get ahead? Somebody making $50,000 a year now will never, ever have a down payment for a house. I mean, unless they're going to live in that part of town that you don't want to live in, right? So it seems to me that a lot of the quits rate is probably people jumping from job to job saying, I can't live on this. I simply can't live on this. So they might be in a larger city where they can't afford to pay rent, and then they quit that job and they move to a second tier city, like get out of Cincinnati and move to Columbus, or get out of Cincinnati and move to Toledo. And maybe you can afford rent there and get a job with the same pay. Maybe a lot of the quits rate is that. Again, this is something that a good Google search can do. The Fred data on burdened households. Yeah, it's I didn't find a nationwide one. You almost have to click in every county. It has like lists and lists and lists in this county and that county and this county. And some are going down, some sideways, some up. So it was all mixed. OPEC just cut oil production today, resulting in a price bump for oil. Could energy-driven inflation feed back into core PCE and cause the Fed to raise rates higher than they otherwise would have? Well, one thing is for certain, it's not helpful. That we can say. So inflation, there has been some disinflation going on. This is not helpful. This is counter to that trend, or it has the very potential to be counter to the trend because GDP is energy intensive. Everything requires some kind of form of energy to get somewhere, to do something. You say, well, what about going to a restaurant? Well, you got to drive there, and then the restaurant has grills which run natural gas, and all the employees had to drive there as well. Well, that has a cost. The owner had to drive there. The employees are going to say, well, my cost of living has gone up. I need more money. It feeds through into everything. Whether or not it gets passed through, whether or not we continue higher, which I'm hearing more and more that we're going higher on oil. We breach 100, then yeah, I think that you can see headline inflation definitely go up. In fact, the next headline inflation will probably be higher because headline has energy and food in it. And food has to be transported, which means it's going to cost more to get food into the stores simply because the price is up like 10% because of that jump. So yeah, it does have the very real potential to find its way into costs. Whether it finds its way into prices, given the weak demand that we've been seeing lately, that's another question. But we know this for sure. It's not helpful. You cannot put that on the bull case. You got to put that on the bear case. Two-part question. If the market is moving like banking credit issue is behind us, then why is KRE still battered? When will this be considered again? Yeah, the banks are taking it on the chin for sure. Bloomberg ran a story, I think twice or three times today. They mentioned the most shorted bank in the world right now is TD, a Canadian bank, my bank, most shorted bank in the world and they said 3% short interest. Come on, you got to be kidding. That can't be the most shorted bank in the world. I think they mean by dollar volume. It ends up being like 3.7 billion. But, that's, I think they meant most shorted in terms of dollar volume, not percentage of shares, because 3% is nothing. I mean, I think GM has, at any given time, 3% of their shares short. So I don't really see that as being much. Yeah, there is the narrative that we did not have a credit crisis, we had a liquidity crisis, and the liquidity crisis is solved because now banks can pledge their collateral at par and get loans against it. As William Dudley says, there's a comment later on about this, that the banks didn't have a credit crisis, they had a liquidity crisis, so it's not going to affect credit. But on Bloomberg this morning, Loretta Mester said, yes, it is going to affect credit. It always does. Whenever these things happen, it does affect banks' willingness to lend, even though it wasn't a credit crisis. So the KRE is probably, because it's regional banks have a lot of commercial real estate on their balance sheets, like the most per percentage of their loans, they have the most, not the most dollar-wise, but the most percentage of their loans. And I read one story today I think it was Morgan Stanley that put it out, that said they see 40% downside in pricing to office. Now, I want you to think about this for a minute. Thank God I'm out of all my REITs, by the way. I mean, some of the REITs that I was in have just cratered since I got out. One of them was down over 30% today alone because they cut their dividend. But if you have an office property, let's say it's a $100 million office property, and let's just say it's an office REIT with a market cap of $100 million. If you look at most office REITs, they're typically 50 to 55% debt. So they're 45 to 50% equity. And you have 40% downside. What do you got left in equity? 5 to 10%. You end up with a very highly leveraged property. And that 50% of all of the financing on office properties is coming due in the next 2 years. And if you get this kind of downturn, you wipe out the equity, you have your loan to value ratio is going to be close to 90-95%. Banks are probably only going to be comfortable anywhere from 40 to 60%. You're going to have default after default after default, bankruptcy after bankruptcy after bankruptcy in the office space, because the back to office just doesn't seem to be picking up any steam. So that's why the KRE is in trouble, because I think it's like 70 to 80% of the loans made by regional banks are actually in commercial real estate. So if the price is falling, it's wiping out the equity first, which means the leverage of that company is going up every single day. Get to a leverage point where a bank is going to say, we're not financing that much of the building, given that only leaves you with 5% equity or 10% equity. So I would not be anywhere near office properties. Being short for long enough can hurt, even if you end up right. When do you think you should cut your losses? When your conviction changes about the market? Yep. If something happens which changes the facts, I'm out. Or when a threshold of loss is breached. I don't really get to a threshold of loss because I do have patience. And if I have a conviction, I'll suffer it. I'll just suffer through it. And if my conviction is not as strong as I would like it to be, I'll always sell puts. If I'm short, I'll sell at the money or in the money puts. It's better to break even on a position than to lose money, so I'll sell puts, and if the market keeps going up, I'll keep rolling up the puts, rolling forward the contracts, rolling up the puts. At some point, I'm going to be right. And you know, when I'm in loss management, I'm looking for break even. I'm not looking to profit on it anymore. I'm looking to break even. I usually see that coming. I'm a long way from break even now, even though I've given back, and I'm not kidding you, with the rally, I've given back about $750,000. That the position was in the money by, and well, it wasn't in the money by 750, but as it was going up, I kept adding more on the way up, adding more of my short position. So I'm $750,000 away from where I was before. This was as of Monday, but the last couple of days have started chipping away at that. I'm not going anywhere. The facts have not changed. In fact, this week, you know, with the oil cut on Sunday, it dropped into the bear. You know, if you're looking at the scales, it dropped onto the bear side. Both the PMIs dropped onto the bear side. The jolts dropped onto the bear side because you had the quits rate still over 4 million. Sure, the job openings are a little under 9 million now, but let's put that in perspective. That's still over 6% of the workforce, of the labor force, and unemployment is at 3.5%. So yeah, it's coming in the right direction, but it's a long way from being where it needs to be. It's the quits rate. The quits rate tells you how confident the worker feels about switching jobs, and they're not switching jobs to get less money, right? They're switching jobs either to get more money or to move to a cheaper place for the same money. How do you come up with the implied volatility percentile stats? On option trader window over here, you'll have a little gear icon. Click on the gear icon and you'll get a window popping up. You'll see an option here for the stats that you want, and on here just go down until you see the Greeks. and then the window pops, not the Greeks. I think anyways, click on this gear icon. I can't remember it off the top of my head, but when this window pops open, it's pretty self-explanatory. You should see the entry you want, and then the other window opens up, and then you should see, I think it's volatility, and then it has a whole bunch of options. Click on 52, 13, 26, and then there is the arrow that tells you to put it in the middle box. Click on the arrow, then click apply at the bottom. I know that was a terrible tutorial, but on the options chain window, click on the gear icon for settings. It's pretty self-explanatory after that. Also, just an observation, interest on reserve balances is higher than the IRP, so I don't think banks are a contributor to the IRP. IORB is currently 4.9. So I did look that up, and I looked at the current reverse repo counterparties. This is the list of reverse counterparties as of right now, and you can see which banks are listed: Ally, Bank of America, Barclays, Citibank, Credit Agricole, Goldman Sachs, HSBC, JP Morgan, and then the government-sponsored enterprises. That should not surprise you at all. The Federal Home Loan Banks, they're the second last lender of resort, and then different money market funds. So you can get this right off the Federal Reserve Bank of New York. Just look for reverse repo counterparties, and it'll give you who the counterparties are. I think the point you're making is that the interest on reserve balances is higher, so it's less likely that the reverse repo is probably the banks at that point. It's not as if banks don't use the reverse repo. It's just you're saying it's less likely. Yeah, I'd probably agree with that. I guess what I should do is I should look up the level of reserves, of central bank reserves, and see if that has been increasing. Since they're losing money, it stands to reason that it probably has been increasing. Given all of the money flowing into money market funds, it is probably more so money market funds needing a place to go to, because the 1 month and the 2 month on the treasuries were much, much lower than one-day SOFR was. When talking about the two mandates, I completely agree with you on all points. Not sure if I missed it. But how about the scenario of checking both mandates only for the Fed to then lower rates to get some growth? I know this shouldn't be the case because of the natural rate of unemployment, how the Fed had to do track record of miscalculating even the simplest, most basic calculations out there. The point I'm trying to make to get to is lower rates only for inflation to ignite again. Yeah, I think you're right on that. Is if you have full employment, the full employment box checked. Let's say that they get to you see inflation coming down. There's the 2% target. At some point they say, you know what, we're well on our way to 2%, and you have 3.5% unemployment. I think their fear might be that, well, if we lower rates, we might push wage inflation might just come right back again. That unless we see some slack in the labor market and we see wage inflation disappear, we're not going to be too keen on just looking at headline or just core inflation, because there might be disinflation or deflation in some sectors that might be masking another wave of wage inflation just below the surface if you do anything to spur on the economy. But if you can get unemployment to about 4.5%, let's say 4.2 to 4.5%, and inflation is on its way to 2%, they might see a case for moderating at that point. If there is slack in the labor market and wage inflation is running, let's say 2.5 to 3%, below the 3 to 3.5 normal range. So it's running a little lower than 3%. They've added to the unemployment rate. Inflation is coming down. Nothing in the economy broke. They may start to then lower rates. But that is a really Goldilocks scenario to get to, where everything just sort of has to work out. I don't know. If we think about base rates, a base rate is, you go back through history and you figure out how many times something like that has happened. Those are your base rates. Those are your probabilities. The market right now is pricing it in like this is 70 to 80% probability. Where through history, if you look at all of the events of soft landings, of all of the hiking cycles, I think it was like twice out of 13. 2 out of 13. 1 for sure, 94, 95, but we'll give it 2. 2 out of 13 is your base rate. But the market is pricing it in as if it were, no, that's 11 out of 13 times it happened. 11 out of 13 times it ended badly. 2 out of 13 times was, I guess that's okay. We kind of engineered it. That's all right. But 11 out of 13 times ended badly. Can you please make a video explaining as simple as possible how the banking system works? Wow. That's it? That's all you want? Specifically the operations of commercial banks, the Federal Reserve or central banks in general, and the relationship between the two. Oh, is that it? That is quite a bit, because there's a lot going on in the plumbing, and it's not really my thing. Pardon me, my question doesn't make sense. I don't have much knowledge about this stuff either. It's never really been my thing either. There is a good textbook out there. Let me see if I can see it on my shelf here. Give me 2 seconds. Yeah, I think it's called Financial Institutions. I can't, it's hidden behind some other things right now because my house is under renovation, so I can't get to it. But if you go to Amazon, and you're just looking for a good textbook on financial institutions, it'll cover the whole thing of how credit is created, fractional reserve banking, banking reserves, all the facilities for banks. Get a textbook that is authored by American authors, because it'll be based on the American system, which is probably what you're probably asking for. Or maybe you're looking at the European system, which should be basically the same, but I would refer you to a textbook on that. 2 questions. What is the pickup of $1.34 you mentioned? That means if I roll the 102 put up to the 104 put, by the time I buy back the 102s and sell the 104s, I would end up with a credit of $1.34. So let's say that I had to buy my 102 puts for 40 cents, and I could sell the 104s for $1.74. That is a pickup of $1.34 because I got to spend this and I get this in. That's a pickup of $1.34. The pickup now is 98 cents. I could have got it at 178 if I would have been more aggressive that day, but I didn't. I closed them out today at 13 cents. So 202 down to 13 cents. That's $1.89 on that. So, that lowers my cost on the 110 calls to the point now where I think my minimum that I can make is 17,400. 17,400 I make no matter what, and the spread adds another 30K if it makes the spread. In other words, anything above 115, I make the spread. So I'm in a win-win position by working off the premiums. I'm not done. I'm going to continue to work them off, but TLT is 108 right now. The bond market again is pricing a recession. And the equity market, for the last couple of days seems to get it till about 3:30. Then you get a bunch of people coming and going, no, somebody will fix it before it happens. That rattlesnake's not going to bite me. Look on the mountains up there. You see that little thing, that glimmer of hope? We're going higher. Fed's going to pivot. That rattlesnake won't bite me. Well, when that rattlesnake bites, I am going to dance. I'll even film my little dance. Let's see. Do you think there is some underlying explanation for the bull market we are witnessing right now, rather than just irrational exuberance? Well, I think it is. It's a growing narrative, right? And it starts with the idea that liquidity is being restored. All the banks can borrow now. There's going to be no run. There'll be no need for a run on a bank anymore. The Fed already has mentioned that they're going to slow down. There's probably only one more rate hike, so we're pretty much at the end of that. Earnings are still coming in pretty good. The labor market is on fire. You've got all these people working and earning money, and they're all going to go in there, spend their money. There's a lot of good things that you could look at and point to, but there's a lot of bad things, right? So, that story starts getting a hold. Then you get some short covering, which pushes the market up more. Then you get some other people questioning whether or not they should get back in. and it goes a little bit higher, and then suddenly you're in a confirmed bull market, and it's all over CNBC, it's all over Bloomberg, and all the financial people on YouTube, well, me included, start talking about it being in a bull market, and that gets other people thinking that, well, maybe I'm wrong. Maybe this is not because this is working and that's working and this company's up, and, they're laying off people, which means their earnings are going to be good. Oh, I'm wrong. And suddenly they start getting back in, and it builds on its own until you get to a point where, you start questioning it, and it's like, well, wait a minute here. Nothing has really changed, has it? I mean, just the story has changed, but everything else is the same. And now you got higher energy prices coming in. The PMI suck. And then that so slowly starts to come back to you. And then you start seeing that, well, hang on a second. The banking stuff isn't over. We're still hearing about outflows of money happening from banks. And the shorting of banks is back in the news. I mean, people are publishing the most shorted bank list, and commercial real estate, let's not forget about that. That's a big thing that's going to happen. Then suddenly that starts to weigh in. So it's, I think it is just, you get a narrative that builds on itself. So it has, sort of some momentum. I started my short position on SPY long ago, August 22. Well, I've said this before about short positions. You must be extremely tactical. This is not a buy and hold, because the market 70% of the time goes up. And when it goes down for a short period of time, and then it goes right back up again. So it's not something that you can just short and walk away and forget about. You must be tactical, which means as the market goes down, you have to be willing to lower your short position and start buying some long positions. You're never going to catch the bottom, and it might be uncomfortable. You might be in a little bit early, but there's always the rallies, And you don't want to be short for every single rally. You want to lighten up on the way down, and you want to increase your short position on the way up and lower the long positions you have. And you got to keep being tactical like that. It's a lot of work, but being short is not a buy and hold, or it's not a short and hold. It is a fight, a street fight that you're in, and you got to protect yourself at all times. Dukes up. The moment you let your moment you drop your hands, you're gonna get a punch in the face, and that's what those rallies do. They rip your face off. Feeling the pain right now, and I'm wondering if the market is seeing something I do not. Nope, the market is not seeing something that you see. Can you try to make a rational case for the recent bull market? I think I have. As rational as I can. I do think it is short-sighted behavior, but short-sighted behavior, if you have a benchmark like the market, is rational. If your benchmark is the market, you have no choice but to dance when the music is on. You have no choice. You may not like the rally, but you have no choice. You have to beat your benchmark. Curious to know how your oil versus gas trade are performing with the recent move. So in the last week, oil outperformed gas by about 3.5%. But over the last month, gas has outperformed oil by 1.7%. So if you had the trade on for some time, this rally in oil took away some of the gains you had, but over the last month, that trade is still positive, although you lost quite a bit with the recent rally in oil. I don't play the energies. It was just something that I pointed out because of the shape of the curves and the level of inventories. It probably made an interesting play, but it's nothing I really play. If I did play it, the first thing, now I play the market. So what do I know above all else? The FOMC calendar. When do they meet? I know everything about the FOMC because that's my biggest risk factor right now. If I were playing that market, I would have up on my screen somewhere the OPEC meetings, and I'd have my ear to the ground as much as I can to determine, are they meeting, are they talking, and I would be aware of what risks are happening. I would be aware of inventory in more than just one place. I would be much more involved in it, but I'm not. So, but that trade is still working out, whether it continues to or not. But with a bottleneck in refining, I cannot see how higher input prices cannot lead to higher output prices. I can vaguely recall a Bloomberg article from 2021 period talking about a group of traders making incredible returns because they use volatility to their advantage. Well, who didn't? In April of 2020, when the market fell apart, if you go back to my YouTube channel and you look for some of the videos I did in May and June, I was putting out a risk reversal where you're selling the put and buying the call. And I said, even in 2020, I said year end 4,000, some ridiculous number I put out. I said, don't short this market. Now that the Fed has basically dropped rates to zero and is buying bonds, they got the markets back. Don't short this market. A risk reversal is a huge play on volatility. And those things paid off amazing because that thing caught me by surprise, took me down 30% in 6 weeks. I ended the year almost 30% up, which means that's a 60%. I mean, I recovered the 30 and then went on for another 30. Just with playing a lot of times with the volatility, but just in the directional trade, because once the central bank is at your back, do not be shy. Buy everything in sight. Leverage everything in sight. Use as much leverage as you can. Right now, the central bank is not at our back. They're in front of us. They're not our friend right now. So this is the last time, the least likely I think time for a rally in that particular sense. Going back to the concepts of core satellite approach, is this the strategy you personally exploited during periods of high volatility? Yep, whenever volatility is high, I am selling premiums. That's what you do with volatility. Could you list the strategies covered the Implied series? There's a lot of them. There just are a lot, and it's not, like there are strategies. You could say, here's a covered call, here's a short strangle. That's nothing. I mean, anybody can do that. You can find a list of all the option strategies everywhere. What I do in the Applied series is I'll introduce you to it, but then I'll show you under what conditions you can use it and how to use it. How to look at your break even, what part of the distribution you're playing, under what conditions it makes sense to use something like that. But you can read all about a short strangle, say, oh, that's how it's done. But not every stock should have a short strangle on it. You have to have a particular target. So it's the names of the strategies, big deal. It's how to use it and when to use it and on what target to use it. For example, there is an income factory, and an income factory is really just selling short-dated puts again and again and again and again and again to generate income behind a particular, whether you're doing it in front of the market or behind the market. Well, you need a particular type of underlying to be able to establish an income factory. You can't just do it on any stock. So you can read what an income factory is, but go ahead and find a target. That's the hard part, right? I will have a PDF out shortly because I needed something a little bit more. There's so many questions about the Applied series. I thought, let's just get it all out in one PDF and then just make the PDF available for download. So in about the next week or so, you'll see on the site a PDF that you can download that pretty much has over the time all the questions that I've gotten. I've put into a document. It's not like a Q&A thing. It's just more like an informational PDF, but it does have all of the answers for all of the typical questions that I've got. Mark, explain how to calculate PCE core services ex housing. That one's a difficult one to do only because the information they give you really just gives you services. You'd have to go to the services component. You'd look at the weighting of the services component, and then housing is like 0.16 is 16% of the overall weighting. I forget which video it is in either, but I think you'd have an easier time simply just Googling it. Somebody somewhere has already calculated it, and just Google it, and you'll get what it is. A likely scenario to me when thinking about the affordability of housing scenario and the need for wages to continue to increase over time to support minimum wage lifestyle would be that inflation expectations continue to stay higher, and thus longer rates would also need to reflect that. Well, you could have, yeah. I guess you could argue that because I pay so much of my income in either mortgage or rent, I'm going to need more money. That you might have a higher expectation. Well, if you're asking for more, it's hard to say. Are you asking for more because you're worth more? Are you asking for more because housing costs you so much? Are you asking for more because you think everything's going to cost you more? It's hard to pull apart what part of that is inflation expectation versus just the desire to have an easier life. For God's sake, must I pay 60% of my paycheck in rent or 50% in rent? I'd just like to have some breathing room. Maybe you don't think inflation's going to stick around, but you need some breathing room, and I don't think you're alone. When I look at the rents out there, I just can't see how it's done with rents at that level. I would not short TLT. I would not stand in front of a looming recession because if something breaks significantly, especially credit, you get a credit crisis, the Fed will drop rates fast and you will be crushed. I would not short any fixed income security at this point. I would not short anything with duration. I would be nothing but long duration at this point. Let's see. Interpret the spread between the change in FRM and the 10-year. Well, the spread just gives us an idea of how much, if the 10-year treasury is dropping like it did today, you saw agency do very, very well. It was up 1.6, 1.7%. Same with Annaly, did very, very well. They respond to the mortgage rate, particularly the spread between the treasury and the MBS. And if that spread is decreasing, because that's really what mortgage REITs pay attention to is the spread, they lever up the spread. If that spread is decreasing, the value of the underlying is increasing. So that's really what they're levered against. All it is just if we see a 10-year dropping and the spread is not widening, that means mortgage rates are dropping. And if mortgage rates are dropping, that is good for those with floating rate mortgages. It's good for new home buyers. It makes housing more affordable. It puts a floor under housing. Let's see. Regards to AI, would you think this is another technology shock which will lift up productivity per hour of the economy? I do. I think it has the very real possibility in very specific scenarios. What I have found with it is you can ask it a question, and I've tried a number of them now. You ask it a question and you'll get an answer. If you just change your question a little bit and use words that are more precise, you imagine that you are, I think that you have to sort of put yourself back in the mindset of an academic, and you're writing an academic paper where, a practitioner may use a word that means one thing to them, but for an academic, it has 4 different meanings. And I think that most of the AIs are that way as well, that you have to be very particular about the word you use, that if you just change a few of the words, or you add a few more words, or you be less ambiguous. In other words, the more precise you can be in asking it the question and limiting the parameters, the better the answer you will get. But I do think that as more and more people use it, as it has more and more data, and it sees more and more use cases, it will get better and better. I do think that it probably can lead to a lot of productivity gains. For example, going back to what I did, as I asked for it to generate the Python code to capture the currency quotes. Well, I'll just write FX to capture the currency quotes off of Daily FX, because they're listed on Daily FX. Capture the currency quotes so that I can embed them on my site, so that if you're looking at our price, let's say the Applied series is 320 USD, under it you would have a table of the common currencies and the exchange rate against the US dollar, so you could immediately just calculate what it would be in your own currency. And it generated some Python code. Well, I don't know if it's right, but what I can do with that Python code is I can send it to IT and I can say, there's your plugin. Well, they could look down and say, okay, well, this has to be changed, this has to be changed. But the generation of the table, how it generated the table for, it had some lines up here. This line, it had 3 lines in the table: bid, ask, the quote, the bid, the offer. Was probably right. I mean, you're generating a table. That's pretty standard code. Thing is, it probably saved 1 to 2 hours of a lower level coder coding this, so that it goes to a higher level person who can look at this and maybe in 15 to 20 minutes can fix the code because they didn't have to type everything in, right? So as far as productivity, you could probably, in a staff of 10 low-level coders, after you've learned how to ask the AI a question with just the right amount of detail, because you do have to train yourself on training it, then yeah, I think you could reduce that staff of 10 to 5. Absolutely. I do think it has that potential. And if it does, yeah, I think you could see earnings for a lot of companies increase, because they will decrease their labor costs, which, well, that's what productivity is, right? The same output for less labor. What jobs and areas would you think it would impact the most? Well, routine cognitive. I think we know routine cognitive. Jobs that require judgment but not intuition. So intuition is something like a therapist, right? You may be able to get one of these to act like a therapist, but a good therapist has intuition, can listen to somebody talking and can say, okay, I know you're lying to yourself and you're lying to me. We're not talking about the real issue here, are we? Whereas an AI would not know that the person is not talking about a real issue, would just take the words as given and say, you're saying this to me, I have no reason to disbelieve you. Whereas a professional would be skeptical, depending on the body language, depending on where the person's eyes are being cast to, depending on the history of the person. That therapist would then say, okay, look, I hear what you're saying, but you're not talking about the real issue here, are we? It's hard to get somebody to be honest with themselves when honesty about yourself hurts. It is hard to get you there. I don't know that AI could do that. So jobs that require intuition, I think AI is going to have a hard time with. But jobs that require just judgment, should I use this data structure or that data structure to store this information? Should I use this data structure to pass these variables or that data structure? I think AI could probably make those decisions probably better than a human, but not intuition. Could you expand on market efficiency and market correctness? My understanding is that market efficiency is market relates new information efficiently in its price, which I think the U.S. market does, but whether the information is correct or not is questionable. I'm not questioning the information. I'm questioning the interpretation of the information, right? So if there is a narrative in the market and information comes out that is contrary to that narrative, but it's a small piece of economic data, whether it gets priced into markets is a different story altogether. The market can be completely wrong. If we look at, for example, Tesla's share price went up over $200. It reported the amount of cars it delivered, and it was less than expectation. So then the fear came in, well, BYD is delivering more cars, margins are going to get hurt, and down it went. So the expectation was wrong, the interpretation was wrong. The market is looking at very short-term things and looking at volumes. Well, you can't just look at volume. You got to look at volume and margin. What's the point of doubling your margins doubling your volume if you cut your margin in half? EPS will be flat. And if you're trading on a multiple of EPS, why would you be worth more just because you're selling more at half the margin, right? So there's a whole bunch of different opinions all at once, and some people think that, well, the market weights all of those opinions. Well, not really. What do you think a short squeeze is? A short squeeze is those with negative opinions being squeezed out. So suddenly their short position, their short thesis is not reflected in the price any longer. What efficiency means is that there is no impediment to the price reflecting your opinion. So, for example, in this neighborhood, there are no houses for sale in this neighborhood. So the only information we have are what the last 5 or 6 houses sold for. Well, that's all we have. Well, let's say that everyone believes that housing prices are a lot lower today. Well, it's an inefficient market because there's no way to get that belief into the price without something gupping up for sale. That's the only way to get that information in the price. So if you have an illiquid market, it's inefficient because it cannot reflect prices. Now, the belief may be wrong. It may be wrong that the prices should be lower. In fact, you could make the argument that because the city doesn't allow houses to be built on properties this size anymore, that this house is actually worth more because this size lot is now rare in this city. You cannot build one house on a lot the size that I have. The city won't allow it because they want density, so it could be higher. But you see, it's an illiquid market. You cannot get that information into the price to determine, well, do people think it's higher or lower? So there is a difference between the speed at which information can get in prices versus the correctness of the price. You have to assume that that the information going in is interpreted by people the same way, and that those who have a differing interpretation can actually be represented in the price. Well, what if they're too small? Short positions are usually small, but what if it's the right position, right? So it's the market is efficient, but not always correct. Sometimes it's correct, but not always correct. Let's see. If the market continues its rally, what would you do? I recall last year you had GM position. The market did not agree with you. You essentially break even. Could you share that again? If the market continues its rally, I wouldn't do anything. The only time that I would do something is if the information changes such that I change my mind. That something would have to change that I would change my mind, but I would not acquiesce to the irrationality or the limited ability of market participants to see. I don't think of prices as the wisdom of the crowd. I discard that altogether. There are times where the price of the market reflects the wisdom of the crowd. But there are many more times where the price in the market reflects the stupidity of the crowd, not the wisdom of the crowd. And especially in bear markets, when you have these bear market rallies, maybe they start from, okay, listen, I've made enough money, let me cover my position. And you got a couple of big players covering their position, and that starts a short covering rally, which then goes on to silly extremes. And the price is now reflecting the stupidity of the crowd, not the wisdom of the crowd. So as long as I feel that the price is reflecting the stupidity of the crowd, I don't care where it goes. If it goes higher than where it is, it's going to get uncomfortable, but I'll add to it because I have the conviction for it. And nothing has come out to change my mind. And the one thing that will change my mind is not the Fed pausing, but the Fed cutting. If they cut at this next meeting, if they cut without anything breaking and they just start cutting, that's it. My long position, my short position is done, and I will flip long. Not only will I flip long, I'll double my long position if they do that, because this market would rally 300, 400, 500 points in no time on that information, and I wouldn't stick around to try to save my position. What usually happens, or what do you expect to happen after the 210 curve uninverts? It usually uninverts because something significant has broke, and the Fed is going to have no choice but to cut, and the market knows it. Simple as that. And that's usually what happens after it uninverts. Are you studying any new specific sector investment theme that might outperform? No, I think my biggest plays for post sell-off, I say because I am expecting that we'll revisit the lows, if not lower. Not much lower, but revisit the lows. I think we have to, just to get it out of the way. Otherwise, there'll always be the short side in there. You almost have to now, just to get it out of the way, just to clear it out of the system. If you want a healthy bull market after this, you almost have to. For the next cycle, the recovery and expansion cycle, I can't think of anything better than the U.S. home builders and the large miners. I can't think of anything better right now for what needs to happen in North America as far as home building goes, and globally as far as the shift to a grid goes, and the amount of upgrading that has to be done, and the shift to EV, the amount of copper that is simply that it's needed, and minerals and metals that are needed. I can't think of two better sectors to be in. Is home building and metals and mining. Now, as the economy unfolds, as we start in the recovery, I may find other subsectors and sectors that I think, well, this is interesting and that's interesting. But right now, from where I stand, looking past this recession, those are my two big plays. I was in nothing but REITs for years, all through 2011, 12, 13, 14, and REITs outperformed the market every single year over that period of time. That's not going to happen. You don't have to be in 10 sectors. You don't have to be in 5 sectors. You have to be in 1 or 2 winning sectors. Those are my 2 right there. XHB and XME. Well, I wouldn't do the XME because it's US based. I'd want something bigger. But Freeport, Rio, and the US home builders, I think that's good. I don't understand all the hype around the latest OPEC production cuts. I'm wondering if the cut changes your views on WTI or above trade. Not really. Also, lots of talk on Bloomberg about how the oil price will affect markets. Do you think the cuts will have a big impact on markets or on inflation? Well, the cuts have had a big impact on the oil markets, that's for sure. But if we are going to be pricing in a recession, demand drops significantly in a recession. That it could be that OPEC already sees a recession and is already cutting ahead of that recession. And if there is a recession, expect more cuts because they've gotten used to the margin again. They had it in 2007, 2008, 2009. The price went down, but it recovered for 2011, 12, 13, 14. Then it all went away. And for a while, some of these producers were producing at just a little above their cost, some even below their cost. That now that they have the power to keep the price higher than their cost, they're going to manage the price. Even through a recession, I expect them to continue managing the price, that if demand starts dropping, they will cut production faster and faster. So energy may just continue to stay high for some period of time. Maybe Warren Buffett saw this, and this is why he is so hungry for Oxy, because Oxy, I should clear that up a bit. OXY is the ticker, not OxyContin. Oxy, Occidental Petroleum. Maybe that's why he's so hungry for it, because maybe he saw that would be the end result, is that the world wants to slit their throats. So why would OPEC do anything more than say, we're going to keep prices high. We're going to squeeze you for every penny we can get because you want to kill us. So we're going to kill you first. Maybe they're thinking that, and maybe Buffett saw that and he thought, I see huge cash flows ahead for these energy companies because low capex, because they're not going to explore, they're not going to find new fields, they're going to harvest what they have, and they're going to manage that price all the way down. I mean, when I say down, the demand all the way down, they're going to manage the price up, so as demand is dropping, production will cut. Demand drops, production will cut. Did you sell your ES calls to lower your beta? Well, no, if you sell, so if you're selling ES, you are getting negative beta to lower I already have negative beta exposure, so it's just giving me more negative beta exposure, yes. If so, could you explain how does selling calls on futures lower our beta? Because calls have positive delta, and if you sell a call, you get negative delta. And if you have negative delta, that's basically short. You're basically short, and since it's the ES, it's the futures on the index has a beta of 1, you are basically short beta. I tried to lower my beta on smaller paper trading account using MES options, but the premiums are very small and I can't. No, it's not the premiums that lower your beta, it's the delta that lowers your beta, not the premium. So if you're selling calls on MES, look at the delta that you're getting. That's what lowers your beta, not the premiums. It's not the premiums that lower your beta. I can't wrap my head around from where all of this hedge potential is coming from. It's coming from the delta. What exactly happens when we're called on a naked future option? You won't be called on it because it is never worth exercising a call early. It is never worth exercising a call early on a futures contract. Not that I can't think of a reason why, when you could always just sell it in the market. And then when it expires, well, depends on your expiration date. You'll either, on expiration, it'll get called away from you, which means you'll end up with a short position, a short MES. Are we trying to get called so that we close our future with a profit? No. I can see that you're not quite sure exactly how to use options based on the question. I would strongly recommend you do not use options unless you know what it is that you're doing. And I have this fear that if I try to explain it to you and I explain it to you a bit, you may misunderstand what it is that I'm saying because you based on this comment it's clear that you don't understand it. So I'm just going to say avoid it. If you don't understand it, a general rule is if you don't understand something, just don't do it. Learn about it first, and then you can do it. Regarding fake news story on ABR and some on MPW, I have two questions. Can management do anything to prevent these reports from being published? Nope. It is my opinion that you are a pedophile. I can say that. I didn't say you are a pedophile. I said it is my opinion. That you can't stop me from having an opinion. You can defend yourself. You can come out and say, okay, I'm not a pedophile. But if I said, you are a pedophile, that's slander. If I say it as a fact, that's slander. So as long as I say it as an opinion, it's not slander. Now I could say things like, if you watch him during the course of the day, he's frequently around children. It is my opinion that he is a pedophile. Now you may watch him during the day and say, he is around children. Suddenly my opinion to you turns into fact, but I voiced it as an opinion. If I want to hurt you in any particular way, I can't just make something up. There has to be some truth in what I say that you can look at and you can say, well, that point is true, that point is true, and then I slide my opinion in to bring you to the conclusion. Because you have something you could look at and say, well, this is true and that's true. Pedophile, he's a pedophile. Well, I didn't say you were. I said it is my opinion that you are, right? So you can't stop me from having an opinion about you. Do you have any ideas how these firms pick their targets? Yeah. If you look at most of these short reports, they tend to have one thing in common. And one thing, the way you would scan a whole bunch of companies very quickly is you would look under assets. And you would look for investment in associates. Excellent. Investment in associates. This means when you classify something as investments in associates that you have some ownership within this company, but you don't have influence or control. If you have influence, well then you have to use a consolidation. And same with control. You don't have any influence or control. It's investments in associates. Well, these are opaque. They're hard to track. It's hard to find information on this stuff. You go to the notes and there's some information about, investment associates A, B, C, D, E, and you have a share of income. Maybe you have some dividends received, and sometimes it will just affect the asset account. Other times there'll be nothing received, so it'll just show up on the income statement somewhere. Well, that's a great place to start because you just have to look for something that sort of seems a little odd or that seems a little out of place, but you don't know what's going on. And then you say, well, it has an investment in this associate, it has an investment in this associate, and it does this on its balance sheet, which is perfectly true. And in our opinion, revenues are fake. Revenues are fake for this company here because this is not publicly traded, right? It's not a publicly traded associate. It's not public. So you can make up all sorts of things. In our opinion, revenue is fake. So somebody trying to go through this says, okay, yeah, they do have an investment in accounts, and yeah, that is the right number there, and yeah, they do have these two, and yeah, they did claim this much from this one, and yeah, it didn't show up on the income statement. That's because it was a distribution. It just lowers the investment in associates, right? I mean, it'll be something that you probably might not be aware of for accounting reasons. And then when you start to look for this company, you can't find anything. Well, they're not publicly traded. You're not going to get any information off them. So you can have any opinion about something you can't verify as long as you have pillars of truth along the way. Look for investment in associates, and you can weave almost any story you want. You're probably wondering, how does this guy know this stuff? Yeah, I've lived a good life. Here's one thing that I sort of don't like in business school. There is no course on committing fraud. So they should teach business students how to commit fraud. Same with computer and computer science. There should be a hacking course. Not only just white hat hacking, but black hat hacking. That means the illegal hacking. And there should be a course in undergrad and business schools on how to commit fraud, how to commit fraud by what kind of entities would you have off balance sheet? How would you structure those entities such that you can hide it from auditors, such that you can hide it from regulators? How would you create fake revenues? How can you? There should be a whole course on training you to commit fraud and embezzlement, because how else can you protect yourself from that unless you learn how it's done, right? You have to walk on the dark side so that when you are on the light side, you know exactly what the dark side is doing. I'm disappointed at schools that say, oh, it's immoral. It's immoral and unethical. That's exactly it. And if you want to protect society from them, you better teach me how they're doing it. But the only way you can really get an education in fraud is to go to jail. Because there, especially if it's a white-collar crime that you went to, you're not actually going to jail. You go to a farm. It's like a big camp. You go to a farm. They got menus. You can order steak or whatever if it's white-collar crime. And you're around a whole bunch of people who will teach you how to commit fraud. That's the only place you can get an education in fraud. Now, I've never been in the camp, but I know somebody who has been in the camp, and this is the story they relate. But I wish that business schools would hire white-collar criminals to teach a course on committing fraud so that they can create an army of graduate students who would then know how to protect companies from that very thing because they would know how to do it themselves. It's, the thing about casinos, right? They hire card counters to catch card counters because it takes one to catch one. Right? Banks, a big thing among banks years ago is they used to hire bank robbers to consult with them on their security because, well, it takes a bank robber to tell you how they could not have robbed your bank. I wish they had more of that. CFAI should have more of this as well. There should be a couple of readings in there of how to actually do it. They do have a reading about red flags that you would see. Well, it's not enough to have the red flag. Show me how to do it. Then I'll be able to see the footprints well before the red flag shows up, right? Question on current REIT pricing. I want to increase my REIT allocation. Don't do it, but I'm conflicted between recent price decreases and leading indicators. Don't do it. ABR and AVB, for example, appear to be on sale. Yeah, but looking at ABR, see its portfolio is predominantly bridge loans, multifamily. Well, its lending portfolio, yeah. And lending being predominantly agency. Its mortgage origination, it sells its mortgages to the GSEs, and it is a servicer of the GSEs, which has nothing to do with lending. It has that no matter what happens, they'll continue to service those mortgages. It's not their responsibility. They're just the servicer. They're not the creditor anymore or the debtor. They're on neither side of that. They're just servicing the mortgage. In other words, they sold the mortgage to Fannie Mae, and all they're doing is they're collecting the mortgage payment and then remitting it to the GSE, and they get to keep a small percentage, like just basis points of everything that they collect and remit if they continue to service. So no, take the agency out. If real estate, especially multifamily, looks negative in the near term, how are you pricing these? I don't think that multifamily will look negative. I don't think multifamily will get hurt as much as office and retail. I don't think multifamily will get hurt. What I see with multifamily is no upside, because most of these places are, their occupancy rates are 96, 97, 98, 99%. Low turnover because rents are high. And so very little opportunity to raise rents to market, or there may be at market rents. And if rents are decreasing, well, they may be even above market rents at this point. Well, when you have that level of occupancy, where's growth going to come from? So I don't see that they're in trouble. It's not as if people aren't showing up to the apartment building. They are. They're just not showing up to the office. If people aren't showing up to the office, well, they got to work from home. Then, well, you can't do it from a tent on the street. You got to do it from an apartment. I don't see multifamily having the valuation issues that office and retail will have. I just don't see where growth will come from. And if there's no growth, well, then I'm done. I'm out. I'm good. Because I can't see the upside. ABR, I'd be more than happy to see this thing sell off. I'm more than happy because I would load up again. I've done it twice. If sold off, bought it, went up. Sold, and then I lighten up when it gets up. Sold off, bought it, went up, and I lighten up when it goes up and it's selling off. Well, I'd love to see a good washout because I'm sitting on a big pile of cash right now, and if this thing found its way to $7, $6, $5, well, I would load up because its mortgage business is strong, and mortgages aren't going away. They're all GSE, they're all agency. It sells it to at least its servicing portfolio, which is becoming a bigger and bigger part of its revenue. The equity portfolio it has, I'm not too concerned about that. If they made their way through 2008, 2009, yeah, they did cut their dividend, but they made their way through that. They're going to make their way through this. That does not mean that I'm saying buy now, and I'm not saying it's going to get to $6 or $5. I'm saying that I would love nothing more than to see it get there again, because for me, I would load up. When you sold September ES contract, what do you mean? It means that there is a futures contract that expires in September, and I sold that one. You sold the September ES contract? No, I sold the futures contract expiring in September. Not a call. Because when you said you sold a call, you listed the strike price. I sold the June call, June 16th call, with September as the underlying, not June as the underlying. There is a difference between that. There are two options that two options that expire, two series of options that expire on June 16th. One of them has the June futures contract as the underlying. The other has the September contract as the underlying. I sold the calls on the September underlying, not the June underlying. If you've never sold options on futures, be very, very careful, because you could sell a call on a futures contract thinking that you have the next month contract when you have the further month, or you may be wanting the further month but you got the front month. You got to be sure which underlying is under which option. If you've never traded them before, try. I don't want to say don't do them, but educate yourself on it first before you do it. I've been watching your videos for a period, and due to the fact have considered pursuing the CFA designation. Excellent. However, I am skeptical about pursuing the designation because of the emergence of AI. The AI will augment what you do, not replace you. However, if you can't build intuition, if you can't be strategic, then yeah, AI will replace you. I mean, if all you're going to do is tasks that a computer can do, then yeah, Yeah, probably not. But this is what the program, this is what CFAI is meant to give you. Is meant to give you sort of a level 1. AI could do anything in level 1. Level 2, AI could probably do that as well because it's a lot of valuation. But once you get to level 3 and you start getting to portfolio management issues, I'm not too sure that AI has the intuition to do that well. I think that AI could be a good tool to augment, but I'm not sure that it could do it well. But hey, I could be proven wrong. I don't know. The Bloomberg AI claims to be able to build better portfolios that perform better. It claims to do that. I don't know that I would not learn something only because I think a computer or AI might obsolete it. So, for example, when the dot-com era happened, would you have not studied retail marketing? Because, well, all the retail stores are going to disappear. They haven't, right? Sure, online marketing has taken more of it, but they haven't disappeared. So if you're studying finance, over time, as the industry evolves, you evolve with the industry. Humans in finance are not going to disappear. There may be fewer humans in finance, and if there are fewer humans in finance, it's going to become even more competitive, which means you got to stand out even more. Eradicate the industry entirely. Will it reduce positions or it won't eradicate them, because imagine if the whole industry was run by AI. Then you would have a human come along and clean up, because almost every AI would arrive at the same price. Almost every AI would, because they would be using that information as their input against their history, and since it all have the same history and the same time series and the same everything, unless they can be intuitive, unless they can have some intuition, and unless they know how to be strategic meaning that I know you're doing this and you're doing this, so I'm going to do the other thing, which will force you to do the other thing as well. Can they game theory their way through something? I don't know that they can. I know that computers can play chess really well, because chess is a lot of strategy. But I wonder if they can play poker against the world's best poker players, because can AI bluff? Does it know when to bluff? Can it read when the other players are bluffing? Can it know that? It may probably have a great ability to play the probabilities of what the cards are, but in the end, that's all they're playing is the probabilities, and it wouldn't take a good poker player long to see that they're playing that the AI is playing the probabilities and start playing against them. I don't know if they have the ability to think that way. So I don't know. You know what? It's so early. I really don't know. Will it be assistive or assertive? I think it's assistive. What is your opinion on the upcoming L3 pathways? Wouldn't it be better to cover all pathways rather than limit yourself to one and miss out on the other? Yeah, I agree. For me, I would totally pass on private wealth management, because I don't want to be a relationship manager. I would totally pass on that. I know it's more than relationship management, but it's heavy on that. And I would be very interested in the other two pathways. Portfolio management is the basic one, but there's private markets. I'd be more interested in that. I'd want both. I agree. I think they will be available to you after you finish, as part of something you could do for your continuing education credits. We have a charter holder package that's coming out this fall, and it's just for charter holders. You must be a charter holder to subscribe. So in there, we would probably put the pathways, so that if you did one, then you can go through the other one. You can easily go through them. I think they'll make them available to you. Regarding why the Fed would cut rates if both mandates are checked, is it possible they would cut rates at this point because They also know keeping rates higher for longer would eventually break something. They would experiment with easing off the gas pedal in order to avoid severely breaking something. Michael McKee asked Loretta Mester that today. He said, the thing is, he says the story goes that the Fed raises rates until they break something, which is not entirely really what they're trying to do. They don't raise rates until they break something. They keep raising rates until something breaks, and then they go, whoa, back off, too much. So they're not trying to break something, but when something breaks, they got to stop. It's like, oh, no, we went too far. Didn't mean to do that, sorry. So that's usually, they raise rates until they break something, absolutely unintentionally. Thing is, you don't know what's going to break, you don't know where it's going to break or when it's going to break. So it's not as if you can see it coming and ease off the gas pedal. All you can do is say, inflation is too high, we're going to keep going higher, we don't see any stresses in the system yet. Well, you don't until you do. It shows up all at once. On Wednesday at noon, nobody saw SVB coming. By Thursday morning, well, it was pretty much over. I mean, the run started that day, and by the end of the day, it was pretty much over. It was less than 36 hours before, I think, FDIC took over. So it doesn't exist until it exists, and it exists all at once. It doesn't creep in. Considering inflation as a multi-decade high, considering monetary policy known to have a lag, is it possible the market's trading at such high earnings multiple has to do with inflation being so far elevated above the Fed funds rate? After all, high prices mean higher nominal returns for business, and seems consumers are. You see, you have the ... but I have no show more. I know there's more, but for some reason YouTube is not allowing me to see more. So I get what you're saying here. So I think I can clear that up rather quickly. You're saying that, well, with inflation, since EPS is nominal, wouldn't it go up? Wouldn't it just have higher earnings per share because it is nominal? I mean, if revenues are up by the rate of inflation, well, your expenses are probably up by the rate of inflation as well. But if this is higher and this is higher, wouldn't the spread between this make EPS higher because it is nominal? And it would. But if you divide it by price is also nominal, you'll get a multiple. Well, this multiple will tell you how expensive something is regardless of whether you're using real or nominal numbers. A nominal divided by a nominal gives you a multiple or a ratio without units. So you can always judge the expensiveness of a market regardless of inflation high, inflation low, by the ratio of two nominal amounts. And we're in an environment where we're pushing, over 18 and a half times earnings. You have to sort of look at that and say, well, am I willing to pay that? Russia and China recently decided to ditch the U.S. and trade the yuan. But the yuan still makes up, I think, of all central bank reserves, 3%. Also, Brazil and India decided to settle trade in its own currency. What is the impact on the U.S.? And again, see, I have nothing going on here. So YouTube is kind of messing me up here. I don't think it has any effect on the U.S. I think whatever effect it has is minimal to nothing. Which website is being referenced at 1:23:11 to show the calendar of events? That's Daily FX, DAILYFX.com. Look in for all the websites I use. Look in the description box. They're all listed in the description box. How would you suggest managing a losing short vertical call spread that has short leg, which is being tested? Is it best to roll for a credit, which is often hard? Why is it hard? Well, you have four legs, right? Yeah, you have four legs, so you'll have a wide spread because you have the cumulative effect of all the spreads between the bid and the ask. Expand the width, or just leave the position altogether. Well, I don't know. I don't know enough about it to know what to do. I mean, if it's a spread, it's already a limited a limited risk trade to begin with, because the most you can lose is the spread minus the premium you received. It's already limited risk. That's why you did the spread, because it is limited risk. So you got a short vertical call. So minus a call plus a call. And that's working against you, right? Well, what I would do at this point is I would probably sell a put down here somewhere. It's not going to cost me any extra margin to do. Actually, it will, because this is a spread. Whoops, this is a spread, so this is going to actually cost me extra margin to do. Well, let's say that when you originally put the spread on, you had a delta of 0.2, and your delta now is 0.3. Buy 10 shares. You know, you could just buy 10 shares, and if it keeps going up, that's probably the easiest thing to do. When trying to roll for credit on a vertical call spread, I often have trouble getting filled even on liquid SPY ETFs. That's because you have 4 legs. The more legs you have, the wider the cumulative bid and asks are. You could just try going in the middle of the spread and seeing if you get picked up in the middle of the spread, and then slowly walking towards the bid by a penny at a time, giving it 3-4 minutes, see if you get picked up. Between the absurd NASDAQ pricing and the incredibly low IV, maybe it's time to pick up my old rifle again, QQQ puts. Usually when you have a big run-up in something, selling puts is the last thing that I would do. So I wouldn't, but that's me, I wouldn't, because I have a belief that this is not a real, a sustainable rally beyond what we're seeing right now. Massive call skew right now on the pricing. Massive call skew. Don't see this as anything other than another bear market rally like last summer. Same here, though I'm not sure what is going to break this one. Something breaking in the system would do it, but see, look at this, I got to read more. The other ones I didn't. But otherwise, how long will it take before the market accepts higher for longer? I don't know. Might go to 2024 with the intention of getting them for free. I would not be selling puts myself. I wouldn't. But you may see something I don't, or you may be comfortable with the position. I just wouldn't be selling them. What source did you use for daily funds flow? ETF.com. How do you approach rolling short puts you've got on that are becoming profitable for you? Roll them up. If they've already paid off, and I want to keep profiting from it, I roll up. I roll up and forward, or just roll up, but just roll up. I want to participate in the rally, but rolling up and out on a big green day seems like I'm leaving premium on the table. I don't see how. I mean, if you were short the put and the market went up, you've made the premium on the put should be significantly lower. You're not, I think I know what you mean. But by closing it, you're leaving premium on the table because you would have got it. Yeah, but you're closing it only to open something with richer premium, right? So don't look at it that way. Look at how much premium you can pick up by rolling. Aside from these gap up scenarios, do you buy a close at a specific profit target? No, I don't know that I would preference a buy to close. I was reading it as buy on close. I don't know why I'd preference 4 o'clock. Buy to close at a specific profit target. It depends. I mean, it depends on what I want to try to get done. I closed my TLTs today at 13 cents. I sold them at 202. I tried rolling them up and up to from the April 102s to the May 104s, but I just didn't get filled that day, and then it just ran on me after that. So it's like, well, it's at 108 now. Maybe I'll wait a little bit. I'll see what the jobs report is this week. Canada is tomorrow. US is on Friday, and futures trade on Friday. Maybe I'll do something with ZB. I don't know. But at this point, I mean, I don't know that I have a consistent target in markets like this. In trending markets, yeah, you have rules and you have, you put your trade on. If it's an income trade, you take it at a certain percentage to avoid any elevated gamma risk. But when markets are like this and you have to be tactical, well, like the Fed says, you're data dependent. So every day your trade is data dependent. It's like, well, I'll see what today brings. And I guess that's a good way to say it, is for the most part, I'm data dependent. I watched Bill Dudley on the Princeton Benham channel. By the way, everyone should watch that one. It was pretty good. He was questioning whether banks would really tighten credit when the issue was more liquidity duration mismatch. Yeah, I saw that one, and he made that point. And he said, it was a liquidity thing, not a credit thing. But Loretta Mester on Bloomberg this morning said banks, after events like this, typically tighten credit. So they're sort of, against each other on that one. I don't know that this would make banks more willing to lend, either unchanged or less willing to lend. But May 8th, we get the SLOOS survey, the Senior Loan Officer survey, so we'll see what they think. Okay, this is just another point about the reverse repo. How much more do we have here? Oh, we're almost done. Okay, I was going to say I'm going to have to cut it off soon. Last week has shown the market believes big tech is safe haven from a recession. I don't believe this is the case. Same here. Most of the mass layoffs among these companies were in the last few months and have severance packages out into June. I don't think we'll see the effects of cost cutting until at least Q3. Yeah, but the market's already pricing that in, right? A lot of companies have and will continue to cut advertisement spending as well. Yep. Which is the main source of revenue for the social media platforms. Yeah, but tech is so much bigger than social media, right? As consumers feel the effects of inflation more every day, first purchases go to luxury items like the new iPhone each year. Random ship from Amazon. The Apple, believe it or not, does have a very low elasticity of price demand, because most of their customers are higher end customers who would continue to buy it anyway. So yeah, they do have some price sensitivity, but not as much as other companies do. I don't see any of these companies outperforming, even maintaining current sales or profits. Well, I think if you say it's hard to see the upside for Apple, I think, yeah, probably going into a tough spending environment, sure. But I certainly wouldn't be shorting it. I won't go through every industry, but if you look at consumer defensive, they've been unable to pass the full effects in inflation onto consumers. Cost of goods sold outpaced sales. Profit margin taking a big hit. That's not to mention sometimes 20% increase in interest expense. I do think financials are on sale right now. I wouldn't touch financials, but there's still a risk of more panic causing another sell-off. I agree. What sector do you see outperforming in the next 2 years and why? I've already said housing and metals and mining. Why you wish to have more implied volatility in TLT to roll the puts so I can get a bigger pickup in premium. I don't want to roll them for 95 cents. I want to roll them for $2. I want a bigger pickup in premium for the same strike, but didn't happen. If implied volatility rises, the premium increases for both the puts. Well, I'm going from April to May, and I'm going from 102 up to 104. So being that this is so near and this is so far and it has a higher strike, implied volatility would push this up a lot, but would only push us up a little bit, so that the spread between them, the pickup I would get, would be significantly higher. But the pickup's under $1 now. Bond issuance is growing significantly over last year. My immediate thought was that companies are becoming more desperate to get capital, because why would they issue debt today and no issue debt last year when rates were lower? You seem to think about it from the point of view of demand. Well, it's hard to issue debt when nobody wants to buy it. If you're issuing high yield and it's yielding 3.8%, you might have a lot of fun saying, no thanks, I don't want it. So why issue it? But if you can issue now at 6%, closer to par, or 6.5% or 7%, actually, and call it 8%, and get close to par on the issuance, as opposed to selling at a discount at 3.8, maybe you're more willing to issue debt at this point, because there's bigger demand, that your underwriter feels that they can place it a lot faster. Normal for a company to not issue bonds because there's not enough demand. Yep. What do you make of Jamie Dimon's recent comments about the situation banks find themselves in are to blame on regulators? Well, he does have a point. The banks were buying safe securities, and nowhere in the ratios that they were calculating did it make any change for anything. And in the stress tests, the big thing on the stress tests was that the scenarios did not account for a rapid rise in rates that did happen. So they were passing their stress tests for a scenario that simply was never going to happen. Like the big scenario ended up being too low for what really did happen. So that the regulators should have been stressing even more, because we say, well, the bank should have seen it coming. Well, same with the regulators. They should have seen it coming too. And they should have increased the strength of their stress tests, but they didn't. So that was his point, is like, hey, just don't blame us. Telling us we should have seen it coming. Well, they should have seen it coming too, right? Would a recession make the stock market go up? Only after the recession. Only after it goes down would it then go up. I've been trying my best among my investment committee to make the counter argument bull case. However, the best argument I can make is that the broad market's up 75% of the calendar years. Yeah, so if you're a long-term investor and you want to look past this, sure. Historically unlikely to have back-to-back negative years. And that historically is difficult to time asset movements with recession. Yep. All that's true. More of a statistical rather than economic or fundamental argument, I find it to be lacking. Could you do your best to provide the bull case at this point in time? Employment is strong. Its initial claims are well below 200,000. Consumers typically spend at least 70% of them every penny they make. So you give them more, they'll spend more. Aggregate incomes are increasing. However, fourth quarter GDI was negative. That is not a good thing. That's gross domestic income was negative. That's not a good thing. There's not much on the bull case that you can make fundamentally, because other than looking at the unemployment rate, the fundamentals aren't really that sound. However, no recession has ever been caused by the economy just going, oh, we're just tired. It has never been that. There's always been a catalyst that has caused the market to turn down. There's always been some sharp catalyst that causes a whole bunch of companies all at the same time to cut back. Not a little bit here, a little bit there, a little bit here, a little bit there. This company adjusts this. These companies lay off. That kind of slow moving train wreck has never really caused a recession. It just is a lot of low growth, just a lot of malaise and low growth. Certainly not a place for equities to rally, right? Usually something happens, and something happens all the time. It's just when you're in a low growth environment and something happens, it usually pushes you into a negative growth environment. I don't know that there is much of a compelling bull case today, to be honest with you. But you can trot out the regular things. And listen, there was, I think, 3-4 times on Bloomberg today, there were guests on making the bull case, and they all point to the same thing. There's a lot of money on the sidelines. Whenever you want to make a bull case, just say, without even looking, there's a lot of money on the sidelines. You know why? Because there's always a lot of money on the sidelines. But that money's not on the sidelines. It's in money market funds. That's its home. That's where it wants to be. So they say there's $5.2 trillion in money market funds. Yeah, but there's always money in money market funds. So that money doesn't necessarily belong to the equity market. It could belong to the fixed income market. It could belong to the real estate market. It could belong to the private equity market. Like, it doesn't necessarily belong to equities, but still, if you want to make a bull case, you can always trot out the tried and true. There's a lot of money on the sidelines. Hedge funds are underperforming their index. You can always say those two things, but just because you can repeat it doesn't mean that you got a bull market coming. Honestly, I don't know that I have a best bull case. What are your thoughts on behavioral finance, economic perspective hypotheses, and increased money market flows? According to Fred, year-over-year rate of average hourly earnings exceeds CPI. As a result, retail investors have more disposable income, therefore using money market as a landing spot before investing in capital markets, given a bit of uncertainty with equity. I seem to think that the simplest arguments are the truest arguments. When you have to start making a lot of assumptions that, well, this is going on and this is higher than this, so this person is doing that, and if they're doing that before they go here, they're going to stop over. If you have all of these moves along the way, it's less likely to be a good story. It's less likely to be real. The most direct story is probably the most true story. That once you start making a bunch of assumptions about what people are doing and thinking, and they're going to do this first, and they're going to go here before they go there, and because this, it's used, the more complex your story is, the more unlikely it is to be the reason why something is going on. So you had a lot of twists and turns in here, so I'm going to just let that go. Well, not a lot of twists and turns, but you're looking at a ratio of two things. They have more, and then you're making the conclusion of this. Therefore, they're using this to land before they go into this because of it just seems to me that it's just too many steps along the way. You calculate salary and expense for what you consider a base level of living in your city. And you said with higher rents and higher grocery costs, wages will increase. Well, I'm not saying that wages will increase, but I'm making the argument that when you squeeze somebody's income enough so that all they can do is work to pay rent and eat, at some point they're going to rebel and say, I can't stay here anymore. So I would seem to think that a lot of these people are going to do what they can to get paid more, which includes switching jobs. And we've already seen with the Atlanta Fed wage growth tracker that those who switch jobs end up getting more money. And we saw again this week the quits rate over 4 million because it is a tight labor market, and you can, if you're jumping to get more money, well, of course you'll do it, just to get your head above water, right? I think that might not be the case. Canadian government wants to reduce inflation by reducing wages. So they're getting as many immigrants as possible to fill the job market. They are doing that. This will put backward pressure on wages. Well, I don't know if it will do that, because you're bringing in people, and where are they going to live? All it's doing is driving up housing. You want to look for a market that has ridiculous housing price appreciation in Canada. Well, duh, you brought 1 million people in for which there was no housing for in a year. So all it's going to do is force people into the same supply of housing, and it's just going to drive up prices. So that is actually, you could say, well, more labor is going to push down wages, but it's going to push up living expenses, which is going to push up the need for higher wages. So you can get this positive feedback loop that, well, we got to get wages down by getting more people in the country. You get more people in the country, rents and housing prices go up. If they go up, it costs more to live in the city. I got to be paid more to work in the city. You pay them more. Well, we got to bring more people in to lower wages. You have to break the cycle by building a massive amount of housing and lower the cost of living for everybody that is working, so that they don't ask for higher wages. But when you keep shoving more people into a fixed housing market, you're going to get a spiral in both housing costs and wages, and you can't solve it by shoving more people into the same fixed housing market. You have to expand the housing market. Otherwise, you're just driving up the cost of living, which has to drive up the wage so you can afford to live, which requires more people to come in, which drives up the cost of housing. You see where I'm going with that? So, there is an issue there. Currently living in Montreal, there are students living with less than $600 monthly. So the calculation for the base level expenditure, people can always change the economic situation. Well, when you say they're living with less than $600 a month, I don't know how they're paying rent on $600 a month and eating, unless they're living 6-7 people to an apartment, or 8 to 10 people in a house, which if you take a tour through Vaughan, Ontario, through Brampton, Ontario, this is what you find is 6, 7, 8, 9, 10, 12 people in a house. 6 cars parked outside in a 2-car parking lot. I'm not kidding you. It is a mess to park. But that's what you see is you see the density of the neighborhoods far higher than any Canadian neighborhood was ever built to handle. The density in Brampton, for example, is about 3 to 4 times the density that you would find in, let's say, I don't want to say Markham or North York, but let's say you go up to, come down here where I live, in the Niagara region. The density in Brampton in each neighborhood is 3 to 4 times more than it is here. Well, city services were never meant for that kind of density. But, so if you say that people are living on $600 a month, I doubt if they've got a nice 2-bedroom apartment on the 5th floor in a nice neighborhood and they're living on $600 a month and paying rent. I doubt that. I doubt that highly. As an example, my country, Iran, has currency problems. In the past 5 years, the exchange rate multiplied by 17, parallel to that, Tehran's average housing price multiplied by more than 17, the rent is almost 10, but wages didn't. I don't know that you said you don't agree with me, but what you just said down here absolutely agrees with me. So I think it might be a breakdown in English. I think maybe you meant to say, well, I think that is the case. Might not be the case. I don't know. With profits decreasing and personal incomes rising. What do you think of Ray Dalio's stagflation outlook? Well, I'm not familiar with the stagflation outlook, but I know what stagflation is. Personal incomes are rising. Profits are decreasing. But this is just a shift from what possibly was corporate profits as a percentage of GDP being too high for too long. There's only so much income to go around. And if corporations go from 12% of GDP to 13 to 14 to 15, well, that means that everyone else has to get less and less and less because, well, it is a share of GDP. And GDP is not growing that big. So because personal incomes are increasing, it stands to reason that the share of corporate profits in GDP would have to shrink. So I don't know that would lead to a stagflationary outcome. Could you share some past data on stagflation environment? I don't have any. The last stagflation environment was the 1970s. And I was in grade school, and I was more interested in MASH and Happy Days and Mary Tyler Moore Show, because those were the sitcoms of the days, than I was with any kind of stagflation. I know agency buys MBS and hedge out risk-free rate, but how are they leveraging mere spread? Well, repos. That is how you do it, right? You finance the MBS with a repo, and you hedge out the interest rate component. So being that you have lots of leverage in the repo, when you hedge out everything and you're left with the spread, well, then you have a leveraged spread. If you're 99.99% sure the market is wrong, but, quoting you from the previous Q&A, no, never no go against momentum. Usually single stock names will demonstrate momentum, the kind of momentum that you want to avoid. Markets usually don't display a lot of momentum. They may have, sharp rallies here and there, but I don't know if I would call that momentum. How would one enter a position when the whole market is in fact wrong and not yet showing signs of reversal? Well, if you're nervous about it, you enter small and lightly. It's better to participate a little bit than to try to, hit a home run. Get on first base. Scary indeed. ChatGPT does almost everything an equity research analyst can do, and even more at a much faster pace. I don't know if you think this makes CFA candidates less useful, or do you think they should concentrate their efforts? I'm going to pass on this question here because at some point I'll have more to say on this. That's it. We're done.